Welcome back to the Bull Moose Podcast. For this episode, I will be your host. I am Andrew Witt, joined by partners Mike Bark and Ryan Walsh. We are going to do a mailbag episode for this time. We have a bunch of questions that are asked by clients over the months and years, and I think this is a good episode to go over those and get everyone's feedback on them. So we're going to first start off with some bookkeeping questions. A lot of clients over the past couple months ask us bookkeeping questions. One of them are, how often should I update my bookkeeping?
Yeah, I mean, I think that's a good question, Andrew. I think certainly at least monthly, if not more often. I think you can get away with quarterly, but I strongly suggest at least monthly, because I think you should be reactive to your financial statements and monitoring them as often as you possibly can.
I do think, certainly with AI and the ability, if a person wishes to do their own books, the feeds will allow for you to go in every minute if you want. You could probably bring that down to once a week, but I do think once a month is a good cadence to know where everything's at.
Yeah, and I think having updated financials, especially on a monthly basis, helps with everything. It gives you the opportunity to analyze your business, and then you're going to have bankers come and request them every once in a while anyway, if you have a note due. What are the options for bookkeeping softwares, and do we have any preferences to either ones?
From my standpoint, you look at, if somebody's going to do their own bookkeeping, you're going to want to be in a QuickBooks environment. And Brian would attest to this. I think if we're doing the bookkeeping, we like using a software package that is more accountant based, and we're able to, I think, produce a better financial statement. Have either of you guys dealt with Xero or some of the other ones that are out there?
I have, yeah. I've dealt with Xero. I've actually a lot. I've had a lot of clients in the past who use Xero. It's okay. It's not my favorite. I prefer QuickBooks a lot more. I find that QuickBooks is just a little easier to figure out what's going on. Xero has a couple of weird quirks in the bank feeds and things like that. I haven't used it in about a year, so I don't know if anything has been updated since then. It works fine. You can run financial statements just as well as you can in QuickBooks, but I find that the posting the bank feeds is a little less intuitive than QuickBooks is.
My one qualm with QuickBooks, at least recently, and you guys have probably had the same experience, is they seem to continually update things, and a lot of the updates they're not overly relevant for our clients, but the fee just keeps going up every year.
Yeah.
So I think that's the big drawback for QuickBooks. If you're a software developer, there's a good lane. If you can create a great accounting package that's easy to use, it's open.
Yeah. QuickBooks fees have gone up tremendously in the last 2 years, I would say.
It seems like the updates always make the software slower too.
That is a big thing, is you are using an online platform or this software as a service, and I just look at how quickly we can do our books with our own software that we use versus QuickBooks, and I think my experience has been we're quicker in the other bookkeeping software.
Yeah, I would agree. I actually prefer Accountants World over QuickBooks, but you're right. If clients want to actually have access to their financials where they can log in and see it, then QuickBooks is the ideal choice.
Yeah, I agree. Yeah, and as Andrew mentioned, Accountants World is the internal software that we use for clients that don't necessarily care to do their own books and want to try to save some money. We offer like an internal software, general ledger software that we can use that works really well.
Yep. Now, in regards to bookkeeping, can clients do their own books? Is that a good idea? I know in the past clients have tried it and we kind of put them on, like, I don't want to say a trial basis, but if you do your own books and it looks okay and there aren't many adjustments needed, then they can keep doing it and it's not a big deal. But what are your guys' takes on that?
Yeah, I think it just depends on the client and how careful they are at what they're doing. I think for the most part it can be handled by themselves, sort of with us overseeing it, and I mean, at the very least doing quarterly adjustments or quarterly reviews, or more likely monthly reviews. In terms of just entering transactions on a monthly basis from your bank account or your credit cards, I think generally most people can handle that. But I do find that when they do, there's often mistakes. Oftentimes, doubling up credit card payments, and then the bank balances don't match. But that all gets fixed in the end when we reconcile or review it.
I mean, for me, I always come back to, is it the highest and best use of your time as a business owner? And if you enjoy doing it and if you can be accurate with it, it's perfectly fine to do. I mean, it's not rocket science. But I would say, I mean, there's a reason we go to school for 4 years, to become CPAs and stuff. So it's not quite as simple as, sometimes it's made out to be. I think the other thing I would just bring up, if you're considering doing your own books, I guess my observation is whatever side of the brain that accountants work with is different than the side of the brain that medical and dental people tend to use. And I mean that as a complimentary thing. If I sit down to do a Lego set or something like that, I'm completely lost. I would have no idea, if you gave me an orthodontic case, how to bring all those teeth into alignment or anything like that. And sometimes, when we're trying to talk numbers with them, you can tell they don't get that side of the brain quite as much. So, it comes down to, are you comfortable with it? Is it the highest and best use of your time?
Yeah, I agree.
Yeah.
Another question that's very popular is when clients do have QuickBooks and they log in to see their balances and whatnot, and they compare the cash balance at the month end, why doesn't the bank balance always match what's in QuickBooks?
So I find it's really just unreconciled transactions inside of the bank balance or the credit card balance. And if you do a reconciliation, you can kind of sort of figure out what's happened. Or it's missing transactions, right? Sometimes, the bank feeds are great, but sometimes they do miss a few transactions, and you can find that when you're doing the reconciliation. Or oftentimes, if the client is printing checks out of QuickBooks, right, then maybe a check hasn't cleared the bank. That can cause the balance to be different.
Yeah, I mean, why the feeds and everything like that are great and can save time. If you don't know what you're doing with the feeds, if there's certain transactions you're supposed to add, there's certain transactions you are supposed to match, because they're coming in from a different source. I just cleaned up the books of one of my clients who was writing checks out of QuickBooks, so they entered them in once, and then when the bank feed came through, they added that check a second time instead of matching them. So needless to say, they were taking out double the amount of checks, and their cash balance is way lower. So you do need to know what you're doing on that front. But a lot of times, like Ryan said, it's the reconciling items, and that's why you reconcile statements on a monthly basis.
Yeah, that's why reconciling is so important. I mean, I've taken over clients who don't have checking accounts reconciled for years, and I mean, you just never know what's missing or what's a duplicate or whatnot.
Right. I think the most common one I see is, they pay the credit card from the checking account, and then they go to the credit card, and rather than matching to to that credit card payment that they already sent, they enter it again. So then, in effect, you get double credit card payments in the bank account.
Yeah. What reports should every business owner look at each month?
Well, I think.
Go ahead, Ryan.
Oh, sorry. I think the most important one is the profit and loss and the balance sheet. I like to look at the profit and loss by month. That's my favorite way of viewing things, just to see the the trends from month to month. And then I think the cash flow statement is the third most important. I think those three are the most important to me.
Yeah, I mean, because if you look at our dental clients, they're going to be keeping their accounts receivable. I do think they should look at accounts receivable and their certain practice management reports, and we'll probably get into that a little bit later. But I think just understanding your P&L, I like Ryan's thing where you look at it on a monthly basis or you look at it month over month to see how your trends are going. I also like to look at how does everything look as a percentage of revenue, because most of the metrics you're going to look at or the benchmarks will be based on percentage of revenue versus the absolute dollar amount. So I think taking a look at that's really important.
Yeah, I'd agree. And this last question, why is bookkeeping so important if I already know how much is in my bank account? I mean, we've kind of already went over that a little bit, looking at the P&L, the balance sheet, the cash flow statement, analyzing your benchmarks, things of that nature.
I think one thing I would add on that is you don't have to be overly nuts or panicking. If you're looking at things on a monthly basis, you can have expenses that go out of whack. For example, if you have a 3 payroll month, your staff costs are going to look high compared to where you think they should be. I do think, though, at least once a quarter, kind of taking a look at that financial and see how you're doing against the previous quarter. And the reason I would say a quarterly basis is over the course of 3 months, you usually normalize for things like vacations, things like the 3 payroll month, things like you made 2 supply orders instead of 1 in a certain month. And that just gives you a better way to kind of review the financial statements and dig a little bit deeper into them versus panicking month after month.
Yeah, the 3 payroll month, that's a good point to bring
Yeah,
up.
it's going to kill your
Yeah.
percentage for sure.
Yep.
Even as an accountant, when you do bookkeeping and look at the monthly financial and see a negative number, possibly like, whoa, did I do something wrong? But then you see 3 payroll month.
Right.
So let's move to some tax questions that we commonly get. A big question we get is, when should a client switch from a sole proprietorship to an S corporation?
I mean, in my opinion, one thing that somebody should really look at is, do they intend on having partners at some point in the future, or don't they? And the reason I would ask that question first, before we even take any tax savings apart, is partnerships or sole proprietors are much easier to add partners to than S corporations are. There's just a lot of picky rules. Aside from that, if you're looking to save taxes from the self-employment tax, I mean, Ryan and I, we were talking about it a little bit earlier, somewhere probably between $300,000 to $600,000 of profit would be needed to get to that point where you want to, where an S corporation makes more sense. And I know, I mean, Ryan, a lot of people talk about the self-employment tax savings, but I mean, don't they have to factor in the qualified business income tax deduction now?
Yeah, absolutely. And most oftentimes they don't think about that. But yeah, like with the S corp, the savings is on the self-employment tax, so you need to have sufficient amount of income, net income, in order to be able to pay yourself a reasonable salary, and then some income on top of that, right, Mike?
Yeah, I mean, that's a big part of it, that you have to take a reasonable compensation. Yes, you will have savings on the self-employment tax, but you have to factor in, now that you can do a qualified business income tax deduction on the overall profit, any wage you take lowers essentially your profit and means you get a lower deduction there. So there's a lot of things that go into it, and I know we're going to probably talk about mistakes that people make on the tax side, and S corporation electing that too soon tends to be a big one.
Yeah.
Yeah, so let's go to that question then. What's the biggest tax mistake business owners make?
Well, I think one of the biggest ones is falling behind on quarterly estimated tax payments, and waiting until the end of the year for that tax bill to come due.
Yeah, because then you get hit with penalties and the interest rates aren't low nowadays.
Right.
I mean, the two biggest ones that I see is somebody will, because they've heard they should be an S corporation, they elect S corporation from the jump when they first buy a practice, and then become disappointed that they can't deduct the losses through accelerated depreciation, because there's all sorts of basis rules with S corporations that make deductibility of losses more difficult, and they should have just remained an LLC. And I think the second one is really not understanding their tax bracket. I mean, we have some tax planning calls with clients, and they're talking about buying new equipment or things like that. We're always going to ask, number one, is it clinically necessary to buy it? But number two, let's look at where your tax bracket is right now. And if you're in a 22 or 24% marginal tax bracket, I know nobody wants to pay taxes at the end of the day, but that's not a bad tax bracket to be in. And sometimes you do want to save deductions for when you might be in a higher tax bracket in the future. So I think getting out of that mindset of, I have to lower my taxes, so I'm going to go out and buy something. And the classic example is the supply person will come in and go, if you buy this E4D or this CIRAC, you're going to pay less in taxes, which, while true, well, now you're buying a $130,000 piece of machinery that you may or may not use to save $35,000 in taxes.
Right.
Yeah.
When you could,
so getting to
when
that,
you could,
buying equipment before year end to save taxes. If you're buying a $150,000 piece of equipment, Section 179, they want to be able to take that entire amount. But if you're already in a good tax bracket, split that over 5 years and get it for the next 5 years.
Absolutely. And then just make sure you clinically, it's something you're going to use and is going to make you more money at some point.
Yeah, that's a good point.
yeah.
Okay, so this is a kind of a 3 deduction question, if you want to call it that. Can clients deduct their vehicle? Can they write off meals and entertainment? And can they claim a home office?
Well, I think it all depends. That's the famous answer.
Standard accounting answer right there, Ryan.
That's right. Well, and in this case, I think it really does. I mean, when it comes down to these deductions, I think you really have to have, for lack of a better term, a story as to why you're taking that deduction, right? Does it make sense? Is it ordinary and necessary for your business, right? So when it comes to a dentist, right, writing off your vehicle, I think you definitely can. I think it's hard to make the argument that your vehicle is 100% business, though, right? I mean, do you guys agree with that?
Yeah.
Yeah, I think no question about it. I mean, because the commute to your work is not deductible. So, I mean, you're looking at, okay, if I'm buying a vehicle within the practice, I'm going to continuing education, I'm going to maybe meet with my accountant, I'm going to study clubs, things like that, I'm going to Costco. It shouldn't be 100% of it. And, quite frankly, I mean, if we're not pulling any punches here, a lot of these deductions happen because the IRS enforcement mechanism right now is nearly non-existent.
Yeah.
So,
Yeah.
tax advisors who don't prepare tax returns will talk about, well, buy a vehicle and deduct 100% of it. Again, I mean, that may very well fly if you never get audited. And
Right.
we have to deal within the reality of you might be audited because we have to practice under IRS guidelines and Circular 230 and those kind of things.
Right. Like, does
But
it?
yeah, absolutely, you can deduct your vehicle, or at least a portion of it.
Yeah, I think a portion definitely. And I think, as long as you keep that business use to a reasonable amount, a realistic amount, I should say. I think you're fine to do it. But yeah, I think writing off 100% of your vehicle is just not smart. A long time ago, somewhere like 10 years ago, I had a young client, social media guy, and, made his living, basically selling stuff on Instagram. And he was making a lot of money, and he bought a G5, one of those Mercedes G-Wagons, and insisted on writing it off 100%. I told him it wasn't a good idea. He wanted to do it anyway. We did it, and sure enough, he got audited. And it was not worth the write-off, to say the least. What do you, about meals? I think meals definitely work. I mean, the IRS guidelines are ordinary and necessary, right? So if you're having a client or a business meeting and it's over a meal, right? I think that's certainly reasonable, to take that deduction. However, you can only do 50%.
And entertainment no longer is deductible. I mean, it used to be you could do entertainment things like going, for example, renting a luxury box or taking a client to a game. Kind of the entertainment portion of that's no longer deductible. Any meals or any food that's associated with it would be. And again, I mean, we understand. I mean, when we're doing clients' books, what we're looking at as we're not your auditor. If your number's reasonable, there's probably never going to be any questions asked about it. But as Ryan points out, everything's supposed to be ordinary and necessary to your business.
Right.
Yep.
And same with the home office, right? That was the third one, Andrew.
Yeah, the home office.
Again, I think again, you just have to have this, you have to have the reason behind it. And of course, you have to have an actual home office in your house that is specifically only used for your business.
Yeah, dedicated spot, and the function of it has to be something that you do at home that you aren't doing at the office, essentially.
Right.
And I mean, for our dental clients, I mean, there is obviously the storyline to have a home office. I mean, there could be human resources stuff, could be charting, could be some things that you want the privacy of your home. But again, I mean, it has to be exclusive use for business. I mean, it is a relatively high standard if it gets audited. I mean, what I think the IRS always has wanted to avoid with this is somebody's not trying to claim their whole house as a business deduction.
Right.
So you do get a prorated amount of your utilities and some other things. It's not a massive deduction, but it's one that could save a client $2,000 to $3,000 a year.
Yep.
I know we touched a little bit about this earlier, but how do quarterly estimated tax payments work? And then to follow that, why would a client owe taxes even after they made their estimate payments?
Well, the quarterlies are basically, like they're called, they're just estimates, right? So if your income, a lot of the times for our clients, so the rules for the IRS are that you have to have 90% of your total tax liability paid in by the end of the year, or 100% of the prior year's tax liability. So oftentimes what we'll do for clients is, and that's called the safe harbor, by the way, like safe harbor to avoid the penalties. So oftentimes what we do is we set the quarterly estimates based on the prior year tax return, right? So so then you end up having 100% of the prior year tax liability paid in by the end of this year. that will avoid the penalties. But if your income has gone up from the prior year, that would certainly cause you to owe an amount at the end of the year.
And I think going on that point of, yeah, I mean, if you and we'll get it from a client. I mean, from all my experience, clients like getting refunds. They don't necessarily like owing in tax. And I think that mindset has shifted a little bit, as money market rates have gotten bigger and it makes sense to maybe hold on to your money. But we're going to set everybody up as a safe harbor estimate. When we do our tax planning meetings, they're going to know, if their practice is doing better, they're going to have more taxable income for whatever the reason happens to be, what their tax due is going to look like. And I admittedly, some people do sleep better and go, I should up my estimate so I don't owe anything on April 15th. But really, the smart money play is if your practice is growing, it's expanding, it has more taxable income, to keep your liquidity for as long as you can and not provide the IRS with an interest-free loan. And I think the other point I would make on that is once you send the money to the IRS, we're not going to be able to get it back for you until April of the following year. So you could be looking at a thing in June where you're going, well, it looks like I'm going to owe more, so I should pay in more, even if you don't have to. And then maybe your facts and circumstances change a bit and you need cash to do something else. It could be buying a new piece of equipment. It could be a marketing campaign that you want to do. So, I mean, my preference is to do those safe harbor estimates and obviously keep people informed of their tax liability, but keep their cash as long as they can.
Yeah, I mean, I think that's an important reason why we do the tax planning meetings. Typically June, July, and then October and November. We get your prior year return done, send it to you. You have your safe harbor estimated tax payments on it. We talk again in June, see where your income's trending, if we have to change anything, and then the final one in October or November to let you know if you're going to owe any taxes come April, etc.
And I think, my mindset is tax day shouldn't be a surprise to you. You should know going into it, whether you're getting a refund to an extent or if you're going to owe taxes and approximately what that's going to look at. But again, hold your money as long as you can.
Yeah, it's not a bad thing to owe taxes as long as you're paid in and you know what's coming, essentially.
Right.
What records should clients keep in case they're audited? I mean, is it safe to say you should keep as much as possible?
My experience with audits, they are relatively few and far between. The biggest thing I've seen the IRS want to look at is bank statements, because really where theoretically, if they're doing a full audit, the low-hanging fruit's going to be kind of an unreported income. So they will add up all of your deposits and go, well, okay, you should have deposited X and your tax return says this. Why are there discrepancies? It could be a line of credit. It could be no payable that you've taken. It could be a capital contribution that you made, or any number of things. That will certainly be looked at. I would keep as much as you can for 7 years, but nobody's going to be perfect. And most audits are what they call letter audits, meaning they want to look at a specific issue. It could be, the vehicle that you want to write off. It could be your S-Corp compensation. Ryan, have you ever come across anywhere they're coming in and looking at every little thing?
No, not really. Like that one I mentioned where, he claimed 100% of his business, of his car. They came in and they looked at everything. We provided all the bank statements, all the credit card statements and things like that. And, from the get-go, the auditor was pretty satisfied just for the fact that, things were reconciled, right? So like everything was accounted for correctly. And, they say that you're supposed to keep receipts and things like that, which it's hard to say not to do that. I think it's important to do that. However, in my experience, they've never asked for them, in the audit. It's mostly off the bank statements and the credit card statements, just making sure that things were booked correctly, and the balance sheet was balanced at the end of the year, and all of that stuff. But yeah, like you said, Mike, I mean, most of the time they're coming in and they're looking at something specific. Most of the audits I've had are from vehicles or S corp reasonable compensation.
And I think as long as, I think you make a really good point, Ryan. I think we have to tell people, yes, you do have to keep as much as you can, but I think realistically, as long as you can get to your bank statements, as long as you can get to your credit card statements that show some type of proof of payment, you 9 times out of 10 are going to be fine with
Yeah.
it.
Yeah, low hanging fruit, like you mentioned.
And keep in mind too, you're also going to have time to prepare for any type of audit. So I mean, for example, if they're looking at your meals and you weren't doing the best job of notating on a receipt or notating on your credit card who it was with, you're going to have time to go back, check your calendar, put that kind of stuff together to support the deduction.
Yeah. Oh, one thing I would add though is if you are taking auto expense, if you're reimbursing yourself, through like an auto reimbursement or anything like that, you're taking any business use of your vehicle, I suggest having a mileage log that supports that business use that you're claiming.
Yeah, absolutely. And it's supposed to be contemporaneous.
Right.
Sometimes it's not.
They have some nice apps for that.
Yeah. Yeah, I use not an advertisement, but I use one called Mile IQ. It makes it really easy, and it pops up every time you drive, and it just asks you, was that business or personal? So there are ways to do it easily nowadays, but I think that's a very important one, because that's one, if you present them with nothing, then they just disallow the whole thing.
Yep.
Yeah. Okay, going to the dental practice owners and managing the practice, should they lease or buy dental equipment?
Well, I mean, they should buy the dental equipment for sure. I think there used to be very good lease deals on equipment back when computer servers were a bigger thing, and clients had to turn computer networks over every 2 to 3 years. It probably made some sense to lease, but I think with everything else, it's probably a purchase these days.
Yeah.
I don't have any clients that lease equipment, really.
Well, and a lot of the equipment deals are, next to 0% financing terms. So, buy it, take the depreciation, pay it over time. I think in most scenarios today, I think buying is more appropriate.
And not to get too arcane just in terms of like accounting and tax deductibility, if for whatever reason leasing does make a comeback, you have to make sure, if you want to take section 179 or bonus depreciation or any of those things, that you have a capital lease versus an operating lease.
Mm-hmm.
And really what a capital lease is you bought the thing. At the end of the day, you usually have some bargain buyout at the end of it. You're usually paying, I think it's like 90% of the overall value of whatever the thing is worth over the course of the loan. So it's just basically a different way to do financing.
Yep.
Yeah. Sometimes we'll see dental practices hiring either W-2 or 1099 contractors. Which should they use? What are the general rules for a W-2 employee versus being able to use 1099?
From my standpoint, so the push-pull on this always is doctor hires an associate and they kind of want the associate to be a 1099 because they don't have to pick up the FICA taxes then. They're not part of the retirement plan. You guys could disagree with me here, but I think the IRS guidance is pretty straightforward on this. And basically what the guidance is somebody who is a contractor should have control of their own supplies. They need to have their own liability insurance. They need to be setting their own schedule. And I think an analogy I would use is when we engage with a client, yes, we have a job for them to do, but we have our own office. We have our own schedule of doing things. We have our own software that we use to utilize the accounting procedure for them. They don't exert control over us in the same way that you do with an employee. So I would tell you, if you look at the guidelines, most associates, 9 times out of 10, are truly employees.
Yeah.
Maybe you guys disagree with that.
No.
No, I don't. I don't disagree with that at all. And, like going back to what we were previously talking about, low-hanging fruit, that is definitely low-hanging fruit for the IRS. And it's easily, it's easily, figured out and negated and corrected. So I think it's a high risk.
I think a client will always ask us, well, what really is a risk? So let's say I 1099 somebody versus W-2. Well, W-2 has a concept of withholding tax. 1099 doesn't. And the theoretical risk is, let's say Ryan and I hire Ryan as an associate, and Ryan does not pay his taxes.
Mm-hmm.
And the IRS looks at Ryan's situation and goes, well, Ryan should have been an employee. And he should have been subject to the withholding. Now they can come back to me for it.
Yep.
So that's a risk you are taking to save maybe a couple dollars in self-employment tax. And even then, I mean, the associate's going to be astute enough to go, well, if I have to pay the whole freight on this, I'm going to want a higher percentage of collections. So it ends up being neutral anyway.
Yeah. Yeah, correct. Yeah, I mean,
I would say if you are bringing in a specialist to do some things, we have some offices that will bring in a periodontist or an orthodontist one day a week. Usually they're coming in, they have their own insurance, they have all those things, they technically meet those provisions of being a contractor. But if you're just hiring an associate to do all the same stuff that you're doing, 99.9% of the time they're going to be an employee.
yeah, especially if you're controlling their schedule and telling them
Right.
when and where to be and
Where to be.
Yep.
And they're using your equipment.
Yeah.
Exactly.
Yeah, it's a good point, Mike. I mean, that whole, tax liability thing, that one's a high risk. I think that's a high risk, and it's easily figured out by the IRS, and they wouldn't even have to work very hard to figure it out. So,
Right. It's a high risk that's just not worth the potential savings at all either.
yep. Yeah, and especially an associate that you potentially pay, let's say you pay them $140,000 a year via 1099. I mean, if they come in and correct that, that's going to be a big slap on the wrist.
Mm-hmm.
How much cash do you think a practice should have in their business? And then should they pay off debt first or invest in growth? I mean, going back to the COVID time, when talking about cash to keep in your business, I've kind of templated to keep roughly like 2 months of fixed expenses, so maybe like your staff costs and rent expense in the business, just as an emergency fund, and that's kind of how I go about it. But what do you guys think?
Yeah, I think I say 1 to 2 months is a good line.
Yeah, even on I think it has to be at minimum 1 month, and my rationale behind that is if you have a short-term disability or something like that, usually you have 1 month's worth of accounts receivable that might be coming in to float you 1 month, and then if you have the 1 month of cash on hand, you get to that third month now where your insurance kicks in and starts paying you off. So I think it has to be at least 1 month, and I always look at payroll, your occupancy expense, and your general and administrative expense. In fact, we even do a ratio on some of our financial statements just to show people that. I think following up the one question you had, and this gets asked a ton, when our clients have a loan, do they want to pay that off, or do they want to invest it in other areas, be it retirement plans or growth or whatever it happens to be? To me, the big thing is the smart financial decision is always to look at the interest rate. And I would say if your interest rate is 5% or less, it probably makes sense just to take your free money and invest it in something else. because there's a reasonable chance you could outperform that. Having said that, I do think there's just some people are going to sleep a lot better at night if they have no debt, and if that, prevents, makes your life less stressful and all those things. I'm never going to fault somebody for paying off their debt.
Right.
Yeah.
Yep.
Would you say buying a practice is better than starting one from scratch?
I think it is. I mean, again, it depends on, the person, but I think you're better off buying an existing practice that you can kind of just step into it and, get the wheels moving quicker. Albeit there's going to be debt associated with that. But I think growing from scratch is pretty difficult to do.
Yeah, I think it's riskier, and I mean it's all about location. I feel when you start from scratch,
Yeah.
you got to look into the demographics and the other practices around the area.
Right.
To me, I mean, the biggest thing that's changed, I mean, because we used to do quite a few startups, but the cost of dental construction right now, or any construction that you want to do, whether it's your house or anything else, has remained at these very high dollar amounts. That you're really talking about, if you go out and you build out a 4-op dental practice and you're going to be a startup, it's going to be a big debt burden to try to get through as your practice is ramping up. Where at least if you buy a practice, even if it needs some fixing over the years, you have time to do it. You have cash flow that's coming in, and you can always kind of make changes to it and tweak things. But I just think with the cost of trying to build out a new space, it's a tough proposition.
Yeah.
Yeah.
When does adding another hygienist make financial sense for dental practice?
Well, I think when the demand exceeds the capacity that you're currently operating at.
I mean, to me, there's a couple ratios you can look at. If you are a full-time hygienist, usually, give or take, full-time hygienist can take on about 750 patients a year. So if you're looking at your active patient account and that ratio is getting out of whack, that's one thing to consider. I always kind of look at, the hygiene production comparative to the overall production, and kind of an equilibrium is the dentist usually does about 70%, the hygienist is doing 30%. If you start seeing hygiene starting to lag, and it's not due to cancellations and stuff like that, and maybe your hygienists are, essentially at their max, and you need to invest in another hygienist to come into it. Conversely, I mean, you might be looking at having to hire an associate if hygiene production is starting to get well above 30%, because now you as a dentist are the logjam in the process.
Mm-hmm.
Yeah. What KPIs should practices track every month? I know on our financial reports we send out, we're tracking dental supplies, lab fees, staff costs, occupancy expense, general and admin expenses, and then obviously overhead. But are there any other KPIs you think a practice should be looking at?
I think you have to, on a monthly basis, I would look at that hygiene to doctor production ratio. Again, I mean, it just tells us a lot about a practice and how sustainable it is. We want to see a hygiene base that is somewhere at least 27 to 30% of the overall collections. If it starts to lag, there's potentially some reasons for that. Or conversely, again, if hygiene production is getting more and more, do we need to add an associate? It just tells us a lot about the practice. I would probably also just look at things like your write-off percentage, trying to make determinations of should you be in or out of network is becoming a bigger and bigger thing within dental, and knowing how much you're writing off from the jump is a big number. I would look at your production per day and to see what that's looking like. and then just making sure you're collecting your accounts receivable.
Yeah. So I mean, that's covered most of the questions that we have for this mail grab video. But one other one on here that I wanted to ask is, what's the weirdest deduction you've ever seen?
Oh boy,
Uh,
I've seen some weird ones. Think about that. I had a client that wanted to deduct his dog, but we actually ended up doing it because the dog was actually making him money. As funny as that could be. So the dog was seriously bringing in income. So we made the determination that the dog was ordinary and necessary to that income.
I would kind of agree with you too, Ryan. I mean, it was a weird, I've had clients who have done that with therapy dogs and things of that nature within their practice. And you would kind of look and go, well, it's really hard to say based on what's written in the IRS code. If you got audited, would they overturn it? They may very well still overturn it, but at least we can look at it and say it's a compelling story of seeing. Well, once you started marketing this way and you put that out there, your production went up.
Right.
And is it because of you? Is it because the dog's there? I mean, at least you have a story on it, and I think that's the way to look at any deduction is. It has to be ordinary and necessary to your business, and the burden of proof ultimately to kind of prove that is on you as a taxpayer that it is. I mean, we always get people asking about boats and stuff like that. They're like, I don't know about a boat. They're like, well, what if I take a client out on the boat? Well, okay, you could deduct the cost for that day, but you can't get too nuts with it.
So what on the P&L? What line item is the dog under?
Account 630 office expenses, or you could go marketing.
Marketing,
Yeah.
cost of goods sold, right? Yeah, I mean it depends.
But I think, like Ryan said, I mean, you have to have that compelling story to it to even bother to defend it. I mean, if I went out and bought a dog today and you never saw the dog as part of bull moose or anything one way or the other, they're going to disallow that. That's a personal item. It has nothing to do with it. But we got a tax therapy dog.
Yeah.
Or maybe if we got like a stuffed moose to put in the lobby. That'd be a weird deduction.
I also see people that want to deduct gym memberships.
Yeah.
What are your thoughts on that?
So the compelling case I would make for a dentist on doing it is, and we'll probably have him on at some point, Dave Dorley, who specializes in disability insurance. Cost of disability insurance for dentists is extraordinarily high compared to other professions, compared to like our accounting, disability and stuff like that. I think you could make an argument at least that would be somewhat cogent that would say, look, I have to do some of this stuff you want me staying in shape. You want me to continue to produce dentistry. There's some resistance stuff I have to do. There's some stretching that I need to do that is just a little bit different. It's probably still going to get overturned on an audit, but you have to be audited first, I guess.
Yeah, exactly. I think it's all about the story and the reason, that you decide to do it.
And I think the worst case, if you get a deduction overturned, I think the key thing is, as long as, basically the IRS standard is, as long as there's a reasonable explanation, even if they disagree with it, they're not going to hit you for the 25% penalty on everything. And I guess one example I would give is I did have a client, and it probably goes back to the funniest deduction ever, but he bought himself a Rolex because it was his 25th year as an owner. And he happened to get audited, and they caught that. And his whole explanation was like, well, it's like getting the gold watch for being here for 25 years. And you're like, yeah, come on. Are you giving other, now, had he given every other employee in the business a Rolex when they hit 25 years? Maybe at least they wouldn't have given him the penalty, because they would have said, well, it's a weird policy that you have, but, again, it just has to be something you have to have a reasonable explanation for it, and they won't assess that penalty.
Ordinary and necessary.
Ordinary and necessary is always the fault line, and having a through story on if you are doing anything outside the box of why it makes sense.
Yep.
So Rolex for yourself just doesn't work.
That's about 50 minutes of questions answered. You guys have any final thoughts?
We'll have to do it again, and because we have a lot of questions on the list.
Yeah, I think if we can do this once a quarter, send in your questions on our Substack articles, and we'll keep them and answer them maybe once a quarter. But for that, this is the Bull Moose Podcast, the #1 niche dental podcast in our opinion, and we'll see you next time.